The heat is on. We have hot accounting topics. This is the Issues Watch podcast. Hello, and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, so we're going to cover one main topic today. I know usually I cover a few different topics. It's more of a news update. Well, today I'm going to go into one main topic today, and actually it's so not new that it goes back to 1994. Woo! Go back in time. So there's been a few accounting pronouncements that have come out during my career that I've actually been able to see it and has an impact on what I've been involved with. The new SAS 58, FASB 95, the statement of cash flows came out all during my career, and it was really interesting to see how it changed things. Well, this one kind of came out and was a little bit sneaky. It was actually an AICPA guidance that came out. Now, some of those that are in the industry, they'll be like, AICPA, it doesn't affect me. No, this affects financial reporting because it's the statement of position 94-6, which means it was put out in 1994. But it's the disclosure of certain significant risks and uncertainties. So while the AICPA put it out, then the auditors start focusing on it, but this really relates to financial reporting. So make sure if you're involved in financial reporting in any way, either in industry or for your clients, that you're listening to this. Now, a lot of you people are doing this right, and the reason why Frank and I bring up some of these topics is because we see a lot of common mistakes when we've been doing peer reviews or we review work papers. Or in this instance, there's a common misunderstanding of certain items, and I'll mention it a little bit later on. So we'd like to bring it up and talk about the topic and make sure people have an understanding or they get refreshed on it. There's a lot of people here, the views, I talk to them, and I know that they're in public and what they're involved with, so give them a little refresher. This falls under ASC, Accounting Standards Codification 275, Risks and Uncertainties. Okay, so yes, so subsection 50, it relates to disclosures. So what this says in that area is, reporting entities shall make disclosures in their financial statements about risks and uncertainties existing as the date of those financial statements in the following areas. Now, a lot of you know this already, but there's four very succinct areas. Of course, it goes on a lot deeper, but nature of operation, including activities which the entity is currently engaged in, principal operations, if principal operations have not commenced. Use of estimates in the preparation of financial statements. I know you're all familiar with that, but we'll talk about that. Certain significant estimates. That's the one that's been bugging me. That's the one that made me say, I got to talk about this one. Okay? And current vulnerability due to certain concentrations. Okay. So let's talk about nature of operations. So most people, when they prepare their financial statements, they just say, so-and-so ABC company, and they make widgets. ABC company, and they sell dog food, or whatever. And that's okay if that's all that they do. But what it says is, the entity's financial statement shall include a description of major products or services the reporting entity sells or provides and its principal markets. So you should be indicating where their principal markets are. ABC company sells dog food in New Jersey. ABC company makes widgets and sells predominantly to the metropolitan area. Sells throughout the United States. Either way, you should be indicating it. If the entity operates in more than one business, the disclosure shall indicate the relative importance of its operations. That's a big one. I usually don't see something like that. Most of the clients that I deal with, they're usually more within one particular industry, so it's not as much of a problem. But you start getting to, these larger public companies, and they have to start disclosing this information. Now, it doesn't have to be all, excluding segment reporting, which is a completely different topic, doesn't have to be all quantitative. But you do have to kind of indicate the importance as it relates to the organization, the significance, predominantly this type of market and also this market. Now, you people in nonprofit, don't think that this escapes you. Not-for-profit entity disclosure shall briefly describe the principal services performed by the entity and the revenue sources of the entity services. So it is important. Okay? That's that topic. Use of estimates. You're all familiar with this at this point. You've seen it for how long, and nobody knows why we've been doing this. Came out with SOP 94.6. Include an explanation that the preparation of financial statements in accordance with GAAP requires the use of estimates. That's what it literally says in the guidance. Okay, so now that tells us why we always have to have the paragraph that says the preparation of the financial statements in accordance with GAAP requires the management to make estimates and assumptions and blah, blah, blah. And I've had a lot of people say, I'm going to take that out because there are no estimates in it. True, if you do a cash basis financial statement, with the cash basis financial statement, the balance sheet is only cash and equity. If you have fixed assets or anything else, it's now modified cash, okay? But if you have fixed assets, depreciation is an estimate. So again, you have use of estimates. So stop trying to buck the system and not include this in there. Include the paragraph in there. It's safe to have it in there if you think that you may have estimates. If you have cash basis, which is this cash and equity, okay, you may not have estimates. Okay, certain significant estimates. This is one I wanted to spend a little bit more time on. Requires discussion of estimates when based on known information available before the financial statements are issued or available to be issued. It is reasonably possible that the estimate will change in the near term and the effect of the change will be material. Those are the two big pieces, that the estimate is going to change in the near term and that change will be material. So most of us, when we're doing our audits or we're assisting in preparing financial statements, we have a checklist, and there's this significant estimates checklist. And the staff people check off everything as a significant estimate. Depreciation, maybe allowance for doubtful accounts. And I sit there saying, how significant is depreciation? Well, it's a big number. I said, I can understand it's a big number. But a significant estimate is it's reasonably possible. Reasonably possible means the chance of the future event occurring is more than remote and less than likely. Okay? More than remote and less than likely. And it's going to change, it's reasonably possible it's going to change in the near term, and the change will be material. Well, depreciation is going to probably change in the near term, but I don't think it's necessarily going to be material, the change, for the most part. And what they're looking for is that you've made an estimate and your anticipation of the estimate was not as accurate as you had hoped it to be. Now, if depreciation is going to go up and down because you fully depreciate an asset, that's something different. I keep picking on depreciation because that's the one people always put down as a significant estimate, and it's usually not. It could be, but it's usually not. As it relates to fixed assets, you could have valuation, you could have impairment. That may be a significant estimate. And I'm going to give you a list of what they put in the guidance as examples. For this to happen, you're indicating the following. It's at least reasonably possible that the estimate of the effect on the financial statement of a condition, a situation, and set of circumstances will change in the near term, and again, that the change will be material. It's saying that you have those two elements. Okay, I know it sounds repetitive, but it's literally within the guidance that way, so I wanted you to at least hear it that way. Here are some examples. Inventory subject to rapid technology obsolescence. Specialized equipment subject to technology obsolescence. Valuation allowances of deferred tax assets. Capitalized motion picture film production costs. They put that in there a lot. Capitalized software costs. Deferred policy acquisition costs. Valuation allowances for commercial real estate loans. Environmental remediation. That type of stuff is the big one that I've seen. The other one, litigation-related obligation, another big one. Okay, amounts related to long-term contracts, estimated useful life of intangibles. Now, there's a few more that they listed, but I just wanted to give you some because I'm just trying to keep on time. The last area I wanted to bring up is current vulnerability due to certain concentrations. They describe it as this: vulnerability from concentrations arise because an entity is exposed to risk of loss greater than it would have had it mitigated its risk from diversification. Okay, you're going to understand exactly what I'm saying when I give you some examples. Disclosures will be required if the following are met. The concentration exists at the date of financial statements. Okay. The concentration makes the entity vulnerable to risk in the near term. Severe impact. The severe impact is a higher impact than material. Okay. It's at least reasonably possible that the events that could cause a severe impact will occur in the near term. Okay, Let's take some secrecy out of this and let's give some examples that we see all the time. Concentration of customers, suppliers, lenders, and contributors for those in nonprofit. Okay? You have concentrations. Concentrations of particular products, services, or fundraising. Concentration of sources of material. These are all concentrations that we've been disclosing, but this is kind of where it starts falling under. 3 more. Financial instruments. Now we have that FDIC disclosure. You know, you have cash in excess of FDIC. This is where it comes up, and this is where the disclosure is kind of emanating from. Labor subject to collective bargaining, and labor outside the United States. Now, what we do a lot of times is if we have labor outside the home country, if we have sales outside of the home country, or we have labor outside, we will try and indicate the extent of such. I think that that's good. I think it's important. Look this up. I want to make sure that you know your disclosure checklist references, but look this up and you can figure out what disclosure you're supposed to have. Okay. In closing, I wanted to let you know about some few upcoming NJCPA events. The Governmental Accounting and Auditing Conference is on July 19th. Renee Rampula will be presenting the new quality management standards during a free Membership Plus webinar on August 11th. And the Atlantic CPE Cluster will be taking place August 21st to the 23rd at Harrah's. If you missed any episodes of the Issues Watch podcast, you can access them at njcpa.org/podcast. And of course, lastly, be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.